and get started. So thank you everybody for signing up for this April webinar. Before we dive into our presentation, we're going to warm up a little bit with this tax brain teaser about Bill. So after working hard for his entire adult life, Bill, who's 65, has finally retired and he's enjoying this next chapter in his life. Bill has $42,275 in taxable income, which includes $25,000 from Social Security benefits this year. And as you can see here, Bill's $42,275 of taxable income puts him in the 22% marginal tax bracket because it's more than $40,525 and less than the $86,375. So towards the end of the year, Bill decides he wants to take out an extra $1,000 out of his IRA to take a trip down to Florida. So how much is he going to get taxed on that extra $1,000? Let's take a look. So the logical answer is that for every dollar of IRA money he pulls out, he pays 22 cents in federal income tax, right? Kind of straightforward. Therefore, if he took out $1,000, he should owe just $220 in federal income tax at the 22% tax rate. Simple enough, right? But he owes $407 in tax, a 40.7 federal tax rate on that income. So thanks to the madness that is our tax code and the unique formula that determines how your Social Security benefits are taxed, the real answer is that Bill owes $407 on that extra income. And it's quite shocking, right? Because almost to the point to where it can't possibly be true. Because if the top rate for a single person is 37%, and that rate doesn't begin until he has more than $510,000 of taxable income, how can he be paying a higher rate with much less income? It doesn't make any sense. But here's the thing, it doesn't have to. It is the tax code after all. So later, I'll explain more about why Bill faces this tax bill for now. The important thing is to realize that when it comes to taxes, the obvious answer is not always the correct answer. So, welcome to our April 2021 presentation on how tax planning changes through the 4 stages of retirement. My name is Tony Lajeunesse. I am the CEO and president of TL Financial Group. Today's webinar is in presentation mode only, and it is also being recorded. We'll send out a recording of this presentation to everybody. And as always, if you have any questions for me, please feel free to email me or contact the office to set up some time with me to discuss your situation. And I thank you for registering for this webinar to learn more about taxes in retirement. And I want to assure you, one of the things about this presentation is that I believe you're going to be better informed about the challenges of retirement tax planning after listening to this talk. And there's some tax changes that are going to be happening that we think may end up happening by the end of the year. And I gave you the handouts for today and also a brief outline of what those tax proposals are. We're also sending out a quick, let's say quick, it's about a 35 minute recording regarding looking back at April and then looking at through the rest of this year. So that's going to be sent out to you here shortly. We're going to be taking a look at the first quarter review of the market trends, where they could be coming in the next few months. And then really 7 key points that you need to know about Biden's American Rescue Plan, and then the major tax changes under the administration and how they may impact your future. So that's going to be sent out to you shortly. And really, tax planning is a really important aspect in your overall financial planning. And that's why you're listening to this today, and that's why I'm presenting it. And you may be wondering, why is a financial professional giving a presentation about tax planning? Because from time to time, as many as you are aware, I present many workshops and classes on various financial education topics, such as Social Security, retirement planning, IRA planning, Medicare planning, cybersecurity, and late stage college planning, among others. So our goal is to always to inform and educate my audience so you understand how critical financial planning topics affect you and your family. And I do this presentation because I've seen many people make mistakes and pay more in taxes in retirement than is really what necessary. And when that happens, it makes our job a lot harder because people have less income in retirement. We have to find ways to make their portfolios last. So taxes can seem complex and jargon filled, even though the underlying concepts are kind of fairly straightforward. So let me take a second to explain how this webinar is going to unfold. The presentation is organized into 4 keys. So each key builds on the previous one to form a solution to our presentation problem, as you'll see. And to help you remember what we're covering here today, for those of you who have registered, we emailed you all the slides along with some bonus material, as I mentioned earlier. Now, I know you may have questions along the way. Again, the most effective way for us to answer those questions is for you to reach out to me by emailing me or calling the office to set up some time with myself. But now there is one other important point that I need to make, and this is for compliance purposes. Everybody's tax situation is different. You should always consult with a qualified professional tax advisor to discuss your specific tax situation, especially about these topics. Traditional IRAs, which are tax deferred, which means you must pay taxes on distributions or conversions at ordinary federal and state rates. Roth IRAs, which are non-deductible. This money grows tax-free and earnings may be withdrawn tax-free in accordance with the IRS rules. With regards to state taxes, this presentation references only federal taxes. So you may end up still facing state taxes depending on what state you live in. So check with your tax professional regarding state taxes. I am a financial planner and I do not provide legal tax advice. What I do is help people understand how the tax code and other rules could impact your financial planning situation and your investments. And then we develop a plan to take into account many of the odd things people encounter, especially around taxes in retirement. We can then therefore coordinate with your tax professional regarding your unique tax situation. All right, now that we have their disclosures out of the way, our goal here is to help you understand that the retirement distribution game, meaning spending assets in retirement, is much different than in the accumulation phase when you are saving for retirement. Chances are you've been in the accumulation phase of your life for several decades, and you've been working hard and trying to save money, and hopefully your accounts have grown. But now as you enter or prepare for retirement, you're in an entirely different phase, the distribution phase. And the distribution phase has new, strange rules that can catch people off guard. And along with those new rules, there are often many changes in your own personal life that can have a big impact on your taxes too. For instance, your children are grown, and that means no more child tax credits. Your house may be fully paid off, and that means no more mortgage interest deduction. If you've already retired, you may no longer be receiving tax-free employer-paid medical insurance. If you've stopped working, you may no longer have the ability to stash income in a 401k or a similar plan to manage your annual tax bill. At some point, you'll start taking Social Security, and sooner or later, when you reach age 72, you'll have to start taking required minimum distributions from your accounts. The list of changes goes on. Many aspects of retirement will affect your tax bill in ways totally different from when you were in your working years. So understanding what these are and how they can impact you is really, really crucial. Okay, at this point, you may be thinking, all right, so what's the first thing I need to understand about retirement and taxes? Well, here it is, our first key. You have to know what your after-tax retirement savings picture looks like before you actually retire. And this is so very important to understand and is oftentimes not handled appropriately or even completed for somebody who's getting to retire. And we think that's a shame. We cash flow all of our clients' assets and show you what your after-tax amount is going to be, meaning what is going to be in your back pocket after taxes on a monthly basis. You need to know that before and while you're in retirement because things can change and you need to be prepared for that. So because a $500,000 401k or IRA balance isn't really worth $500,000, the government has a claim on part of that money because the taxes were deferred. they'll get their share when you're forced to start your required minimum distributions after you turn age 72. Obviously, the higher your tax rate in retirement, the less your account is actually worth. And here's an example. This chart shows you the cumulative after-tax amounts you could expect to receive from a $500,000 IRA earning 6% per year at various tax rates. And as you can see, the lower your tax rate, the more you keep. Simple in theory, difficult in practice. And by the way, of course, this presentation applies to both pre-retirees and retirees. So don't worry if you've already started your retirement. Tax planning is important all the way through your entire retirement. The disclosure text on this slide notes that this illustration is for hypothetical purposes and it assumes a 6% rate of return. This does not represent the performance of any investment or product, and of course your results may vary. Ordinary income taxes will apply to withdrawals from tax-deferred investments, so you need to be prepared for that. As an investor, you should consider your current and anticipated investment horizon and income tax bracket when making any investment decision. But now you may be thinking, all right, my accounts may not be worth as much as I thought, but I'll have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay my healthcare costs when I turn 65. One thing you need to understand when creating your income, your retirement tax strategy is Social Security and Medicare have their own tax traps too that you need to plan for as well, and that's key number 2. So let's review Social Security and taxes. Let's go back to Bill from our tax brain teaser. We want to understand why he paid such a high tax rate on the extra money he took from an IRA for his trip down to Florida. Remember, Bill has $38,000 of IRA income, part of his adjusted gross income of $56,000, which is part of his adjusted gross income of $56,525, and he has $25,000 of Social Security benefits. That puts him squarely in the 22% bracket, and he takes the standard deduction. Yet when he took that extra $1,000 IRA distribution, he got hit with nearly a 41% marginal tax rate, $407 on that $1,000. So let's break down how this actually happens. First, let's remember the only difference between our two scenarios here is that Bill has taken an additional $1,000 from an IRA. You see that in the after Florida trip column, he has $39,000 in IRA income. So now we see here that by adding that additional $1,000 of actual income, it increased both his AGI and his taxable income by $1,850. So that means for every dollar of income he actually received, he's being taxed on $1.85. Huh? How and why? So here's the deal. Depending on how much other income you have, the amount of your Social Security benefits that are taxable is going to vary. So for instance, if your other income is low enough, all of your Social Security benefits will be income tax-free at the federal level. On the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal rate is. So you're not taxed at 85%, it's just that 85% of your Social Security income could be counted towards your taxable income. Bill finds himself in the latter scenario. At his current income, after the Florida trip, for every dollar that he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he must also add an additional 85 cents of taxable Social Security benefits. And if you add that up, that's $1.85 taxable at his 22% rate for every $1 of his additional IRA income that he actually receives. So if you do the math on that, it comes out to a 40.7% real tax rate on that additional $1,000 of income. That's the so-called Social Security tax torpedo. it can impact single filers and married couples with even fairly modest income during any stage of retirement. It's one reason planning takes in retirement. It's one of the reasons why planning taxes in retirement is so very important. It's also important to note that in all of tax planning, there are things you can control and things you cannot control. We want to learn about the things that we can control so that we can minimize our taxes as much as possible. All right, let's review Medicare and taxes. How does this work? So let's take a look at how Medicare and something it calls IRMAA, how that can impact some couples in the go-go years and beyond. First, what is IRMAA? Well, it stands for Income-Related Monthly Adjustment Amount. The emphasis is on income because it is a monthly tiered surcharge. Again, it's a kind of a tax that is actually tacked onto people's Medicare Part B and D premiums. But it only happens if you have income over $88,000 for single people or $176,000 for married couples. So let's take a look at what this means in action. So meet George and Martha here up on the screen. They're a high earning married couple and both are Medicare Part B and D participants. The IRMAA surcharges affect income from 2 years prior, and this couple was on track for $275,000 of modified adjusted gross income, or an MAGI in 2019. But on December the 1st, 2019, George decided to sell a stock he bought for $10,000 on July 1st, 2007. Now he sold the stock for $11,000. The resulting $1,000 of gain was taxed at the 15% long-term capital gains tax rate, plus an additional 3.8% net investment income surtax for a total federal tax bill of 18.8%. So that 3.8% net investment income surtax is another tax that comes into play when your modified adjusted gross income exceeds $200,000 for single individuals and $250,000 for married couples. So now George and Martha owe $188 of tax on the gain from their sale of the stock. So that is 18.8% of $1,000. Or do they? Remember, my definition of a tax is any cost that increases as your income increases. So then, George and Martha will owe more tax than $188 because the gain from the sale of stock pushed them off the Medicare IRMAA cliff into paying higher Medicare premiums. So let's take a look at this. And for many of you, this can easily happen to you. So you got to be really careful about this. This is always something that we're looking at whenever a client wants to take a larger distribution out of their IRA. Maybe they're looking to purchase a condo or a new vehicle. We always have to look at these thresholds to make sure that we don't inadvertently raise your Part B and D premiums. So let's take a look at this Part B IRMAA chart. That extra $1,000 gain, just $1,000, push their adjusted gross income into the next premium tier that starts with $276,000 and $1. Now I've included, if you registered for today, the 2021 key financial data form that has this and among other data points that you may find of interest. If that did not get sent out to you, we can send that to you for those who are registered for this webinar, because you really want to look and see what those brackets are. And if you're not comfortable looking at those brackets yourself, you just give us a call and we'll help you figure that out for your individual situation. So now continuing here, instead of owing $297 each of their monthly Medicare Part B premiums, George and Martha are going to owe $386.10 per month, an extra $89.10 per month times 2, which is $178.20. for an annual total in addition of income-related monthly adjusted Medicare Part B premiums of $2,138.40, all for selling just that one stock and making $1,000 over that threshold. But it's not over yet, because Medicare Part D IRMAA charges are also impacted. So George and Martha will each owe about another $19 per month for their drug plans, an extra $466 for the couple over the course of the year. Adding all the IRMAA surcharges together for the year, George and Martha will each owe an extra $100 a month, or about $2,600 for the entire year. Ouch, not very good at all. So learning how to control this is really, really important. Now combine that amount with the $188 of actual federal income tax that they would owe on their stock sale, and the total tax owed on the $1,000 of gain comes to $2,792. That's actually a tax rate of 279% just on that portion. And so let's do a quick review here, because that's kind of shocking. They sold the stock for $1,000 of income gain. The stock sale was $188, 15% for long-term capital gains, 3.8% for the net investment income tax for high earners, for an actual rate of 18.8%. The extra income from the stock sale triggers new IRMAA tiers. So the total IRMAA surcharges amounts for the year to $2,604 for George and Martha. So the $1,000 of extra income triggers taxes of $2,792, 279% real tax rate, and that is shocking. You see, being pushed into the higher Medicare Part B and D premium range is worse than being pushed into an actual higher tax bracket. That's because if you go over a regular tax bracket by even a single dollar, only those last dollars are taxed at the highest rate. But if you go over with the Part B and Part D income levels by a single dollar, you move into the next premium tier. And it doesn't matter if you exceed the limit by $1 or $10,000. That's why they call it the IRMAA cliff. Keep in mind, your IRMAA payments aren't determined by how much money you made the previous year, but rather your modified adjusted gross income is from 2 years ago. It's another tax thing that catches people by surprise, and it needs proper planning. So making sure that you enroll in Medicare at the right time is a critical decision. If you bungle it, you'll get hit by a lifelong penalty, and I cover this in our Medicare planning workshop. To help you understand, meet Jim and Ann, both 68. Jim retired at 65 and Ann retired at 66. Prior to her retirement, the couple had health insurance through Ann's employer, and they continued that after Ann retired because her employer offers retiree health benefits. Unfortunately, they didn't know that they had to enroll in Medicare Part B as soon as Ann retired. So even though Ann's employer offers retiree health insurance benefits, those benefits are generally paid secondary to Medicare after retirement. But Jim and Ann didn't realize the mistake until it was too late. And thanks to the way Medicare enrollment periods work, they weren't able to begin coverage until the following year. In a worst case scenario, this might have resulted in a gap of coverage for Jim and Ann if they had a major medical need, which would not be good, obviously. But even in a best case scenario, because Jim and Ann missed their deadline to sign up for Medicare Part B, they will each owe a 10% Medicare Part B base premium penalty for life. You see how much that translates into real dollars. They owe $356 extra in 21, and historically, we can estimate that premiums will be higher, so that 10% penalty will grow and grow. Over the course of a lifetime, that could translate into a $10,000 mistake for the couple. For simplicity's sake, we're assuming that Ann's retiree health insurance covers prescription drugs, so you don't have to sign up for Part D. Just know that there's a penalty for that as well. I've also, there's also a Medicare fact sheet. If you would like to have that fact sheet, please email me and I can send you that Medicare fact sheet as well. Now, we've seen how Social Security and Medicare have their own tax trap and unique rules and penalties. So if you're like some who have seen this presentation, you may be asking yourself, wow, are there other tax traps that we're going to face in retirement? Well, the rest of what we're going to cover isn't like what we've seen with the Social Security tax torpedo or the Medicare IRMAA cliff. The public generally isn't aware of those tax squeezes. What we're going to see now is how the tax code in plain view snags retirees, especially when there's no planning. And this brings us to the third key. You must plan how and when you're going to use your taxable, tax deferred, and tax-free assets to manage your income and tax brackets efficiently. You can't be haphazard about tapping your tax deferred savings. Timing is everything, and if you don't plan carefully through all stages of retirement, you're going to encounter unintended tax consequences. Let's take a look by first addressing a question I hear often when doing retirement planning: which accounts to spend first? Like, which ones should we go after first? And one way to help manage your income, both before and during retirement, is to utilize Roth IRA conversions. A Roth IRA conversion is a simple process that allows you to move money from an IRA or other pre-tax retirement accounts like a 401k to a Roth IRA. Now, in general, the amount that you convert is added to your income for the year and will be taxed at your rate. So for example, if Jill converts $100,000 from her IRA to her Roth IRA, she's going to have to add that $100,000 to her income, and the conversion income will be taxed at Jill's rate. So for that reason, it's recommended that prior to making any conversion, you consult with your tax professional so that you know what the overall impact of that is going to be. A conversion doesn't need to be all or nothing though. One helpful conversion approach is called filling up the bracket. And many of you have heard us talk about this before. Often you may find yourself in the middle of one of the tax brackets with room to add more income without pushing yourself into a higher tax bracket. So for example, in 2021, the 22% tax bracket for married couples filing a joint return goes from about $81,000 to $172,000. So if you file a joint return and your taxable income is $100,000, that means that you could add another $72,000 of income without going into the next bracket. Making a Roth IRA conversion like that could make a lot of sense. If you plan to convert a large IRA, this approach is often more tax efficient than converting the full amount in 1 year. Instead, you can make smaller Roth IRA conversions over a number of years, filling up your bracket each time, and this can help reduce the average tax rate you'll pay on your converted money and also spreads the tax bill out over a longer period of time. And with higher tax rates in the future, and with the Secure Act that passed in late of 2019, which now prohibits many of your beneficiaries from having the stretch IRA over their lifetimes. They limited that now to a 10-year payout. More and more of our clients are looking at ways to pay the tax on their IRAs now while rates are less, and therefore also reducing the tax burden for themselves and also their beneficiaries later on in life. So it's something that we really didn't have to really look at in the past because the stretch IRA was a very tax efficient tool for your heirs, but it is no longer that. And so looking at Roth conversions is something that most of us have to now really take into consideration. All right, continuing on here, some tactics you could use in managing income around tax brackets might include withdrawing tax-free money from life insurance policies to keep your income low, or selling highly appreciated stock for low or no capital gains, and then taking distributions from IRAs or 401ks to take advantage of a lower tax rate. And as we've seen, You can also consider partial Roth conversions to fill up lower tax brackets as well. Please reference the American Jobs Plan and proposed tax policy document that we've attached with this presentation. Once we know exactly what those changes will take place or what they're going to look like, we'll provide those resources to you and help you plan accordingly as well. There are also two other pre-retirement strategies to consider, but they don't apply to all people. So the first has to do with how you use health savings accounts. And this would only apply to people who are covered by a high deductible health plan, or it's also known as a HDHP plan. The second has to do with small business owners. Those who want to be extra tax savvy and saving for retirement can fund a company pension plan, which for certain high earning business owners can increase their ability to claim the qualified business income deduction, which is the QBI deduction. Both of these features of the tax code could be used to manage your tax exposure and provide significant tax favored benefits throughout retirement. If either or both of these apply to you, go ahead and take note of that and please reach out to me. Happy to help you. Now, we've seen throughout our webinar today that the critical importance of managing our tax deferred accounts, because once you're over age 72, you're forced to take out required minimum distributions or RMDs, and that can be troublesome to your tax bill. But many people make charitable donations, supporting their favorite nonprofit with annual gifts. So let's look at how your RMDs and charitable giving may work for you with some planning. Let's meet Albert and Shirley here, they're in the 24% income tax bracket. Now, the standard deduction for a married couple filing a joint return in 2021 is $25,100. But Albert and Shirley are over 65, so they each get an additional standard deduction, bringing their total standard deduction for 21 to roughly $27,800. This means that they'll receive no tax benefit for any itemized deductions unless their total exceeds that $27,800 benchmark. So if Albert and Shirley have $15,000 of existing itemized deductions, say from state and local taxes or deductible medical expenses and mortgage interest, what happens tax-wise if they donate $5,000 to charity? Well, they get no federal income tax benefit from making the charitable contribution because it doesn't exceed that $27,800 standard deduction. That's not to say that they shouldn't do it, but they should understand it's not helping them save on taxes. Now, if you're over age 70 and a half and have an IRA or an inherited IRA, there's another way to give to charity than simply writing a check. It's called Qualified Charitable Distribution, or QCD for short. Let me explain how it works so you can see why a QCD can be so powerful. First, some rules. If you are 70 and a half or older, you can make a qualified charitable contribution of up to $100,000 each year from your IRA. If you're married and both of you are 70 and a half or older and both of you have an IRA, you can each make up to $100,000 qualified charitable contribution from your own IRA. Second, any qualified charitable distributions you make counts towards satisfying your required minimum distribution for the year, which is now age 72. However, when you make the distribution from your IRA, it must go directly from your IRA to a qualified charity, or you can receive a check from your IRA custodian made payable to the charity. And folks, we do this often for our clients every year. This is a great way to reduce your taxes if you have a charity in mind, which I'll explain in just a little bit. Third, and this is the odd part, even though you gave to charity, you get no income tax deduction, okay? So you can't do the QCD and then write it off, all right? That'll be like double dipping. So why would I suggest a strategy where you get no deduction for giving to charity? Because when you make a qualified charitable distribution, the distribution from the IRA is never counted as income when you compute your taxes. So let's see how that helps Albert and Shirley. And this is pretty cool if this applies to you. First, let's suppose Albert and Shirley do what many retirees do. Albert takes his required minimum distribution, $5,000 at the beginning of the year, and he deposits it into his bank or brokerage account. He's done with his RMD for the year. Now, being charitable people, they donate $5,000 to charity. The end result is that the charity gets $5,000. Everybody understands that, right? But let's look more closely. By virtue of giving to charity this way, Albert and Shirley's $5,000 charitable contribution is going to cost them a total of $6,200. Why? Because the $5,000 RMD that went into Albert's checking account at the beginning of the year still has a tax cost. Remember, the couple is in the 24% income tax bracket, and 24% times 5,000 equals $1,200. So the $1,200 of additional tax that Albert and Shirley must pay when they file their taxes means the total cost of their charitable gift is $5,000 plus $1,200 or $6,200. Remember, the gift didn't impact their standard deduction. The RMD behind the gift just added it to their income. Ouch. So let's see what happens if Albert and Shirley use the QCD rule to give the $5,000 to charity. Instead of requesting a $5,000 distribution from his IRA to go into his bank account, Albert would simply have his IRA custodian transfer the $5,000 of RMDs directly from his IRA directly to the charity. And that satisfies Albert's yearly RMD because he's over the age of 72. Now, the charity is in the same position as before. They receive a $5,000 donation, and it's a good day. Albert and Shirley, however, are in a better position. They still give the $5,000 to charity. Even though they receive no deduction for making the contribution, their IRA distribution is excluded from their tax return. Therefore, they owe no income tax on the $5,000 distribution. Their total cost to give the $5,000 to charity is $5,000, a $1,200 savings over our previous example, simply by knowing how to use the tax rules to their advantage, and they did it all without ever getting a deduction. But we all know charity starts at home, so it's a natural question to ask, how does retirement tax planning figure in? Well, it's a really good question because the government still wants its share of those tax-deferred assets when you pass away. And like we've seen, how you set things up really, really matters, which leads us to our final key number 4. Organize your assets for your family's benefit. Estate planning still really, really matters. Okay, enough about death. Let's talk about long-term care. This is not a long-term care presentation. It's about retirement and taxes. But believe it or not, there are a number of tax breaks associated with long-term care insurance. For example, long-term care premiums may be deductible medical expenses at the federal level and possibly eligible for deductions or credits at the state tax level. And on the other side, if you're receiving long-term care benefits, and in many cases those benefits are tax-free. So for instance, benefits received from reimbursement style policies are tax-free. So those benefits that you receive from the reimbursement policies, all of that income is tax-free. In addition, cash benefit style policies are tax-free if they don't exceed the higher of your actual long-term care costs or an IRS daily limit amount, which is currently $400. So choosing how to pay for long-term care costs can have a big impact on your estate and your heirs. And I know for many people, these costs can be very expensive to pay out of pocket. So not everybody has the luxury or the ability to do that, but it is at least worth mentioning. And as a fiduciary, we want to make sure that we're looking under every stone and making sure that you're aware of what your options are. So in recent years, non-traditional long-term care policies that blend together some long-term care insurance and life insurance have really become quite popular. Often the first inclination of the insured here is to tap the policy to pay for long-term care costs, but that's often a tax mistake. So let's take a look at Florence. She's a widowed woman who qualifies for long-term care benefits and lives at home with an in-home care. Her yearly care costs are $60,000. Florence's Social Security benefit is $20,000 annually, which covers her basic expenses, but of course not long-term care. She also has a $400,000 in an IRA and a life insurance policy with a long-term care rider that will pay $500,000 to Florence's children upon her death. Alternatively, Florence could use up to $10,000 per month for long-term care costs. Any amounts used for long-term care will reduce the life insurance death benefit. Now, please note this is just an example, and it's not meant to represent any specific policy, but many long-term life insurance hybrid policies end up working this way, and that's what I want to share with you. First, suppose Florence is infirmed for 5 years and uses her policy to pay for long-term care expenses. That's why she bought it, right? So here, Florence pays little to no income tax during this period because she'll have such large unreimbursed medical expense deductions. So the $500,000 policy pays out $300,000 or $60,000 per year for the 5 years. That means her kids will inherit tax-free life insurance of $200,000, which is the remainder of the $500,000 policy value. In addition, her children will receive the $400,000 in her IRA, which will be taxable to them. Now, let's suppose Florence lives for the same 5 years, but uses her IRA money to pay for long-term care expenses instead. Florence still pays the minimal income tax per year because of her high medical expense deduction. And now the kids will inherit $500,000 of life insurance completely tax-free, as well as roughly $100,000 remaining of the IRA money, which will still, of course, be taxable. Comparing the scenarios, the ultimate net benefit is unknown because it depends on Florence's child's or their kids' tax rates, right? But it's hard to imagine a scenario where paying for her care with $300,000 of taxable money with minimal cost to Florence is not a better option than paying for her care with $300,000 of tax-free money. In the second scenario, we're preserving the tax-free money for the heirs and paying for the long-term care with Florence's taxable IRA money. Okay, we're toward the end, and you're probably thinking, goodness, how in the world will we ever manage this? And it's a great question. Let's go ahead and bring it all together. So we started with a clear statement about the problem. Retirees often pay more taxes than expected because of confusing systems, treats various income types differently, and contains hidden taxes and penalties. So let's just do a quick review on what we've learned in the context of the 4 stages of retirement. Under the pre-retirement heading, we saw the importance of understanding the after-tax value of your retirement savings before you retire. We also saw that in those pre-retirement years, it's critical to consider your tax-deferred savings and start taking advantage of funding Roth accounts to fill your brackets, something you do through your early retirement years in lower tax years. We also looked at Social Security and taxes, plus the importance of couples that have benefits strategy that considers the surviving spouse. So you always want to take the surviving spouse into consideration. And we saw Medicare has its own tax-like structure that can push you off the IRMAA cliff. And we saw the importance of signing up for Medicare on time, right in the middle of those early go-go years. That's because starting in your middle retirement years, you'll be confronted with required distributions, and we've seen the importance of planning your income needs before then and the tax issues that are involved. And then we saw the importance of setting up your assets and managing them during the later years of retirement so you can preserve the most for your heirs and leave them with the most tax flexibility. All those items together lead us to the obvious solution to our original problem. Because your tax exposure will change throughout retirement, and you need a strategy that will anticipate how and when you tap assets to cover your personal expenses. understand the range of taxes that you'll face in various stages, and manage your actions so you pay the lowest tax rate possible. Okay, by attending today's webinar, you're indicating that you're preparing to leave the accumulation phase or saving for retirement, and then moving to the distribution phase when you start spending your retirement assets. Now, we've seen that the distribution phase is more complicated than working and collecting a paycheck. So managing your tax rate through the 4 stages of retirement is part of the challenge of retirement planning, which we've seen the cost of those mistakes. And naturally, we want to be efficient with our savings, and there are strategies to reduce your tax burden. But as with many things in life, this takes education, planning, and advice. It's a lot to think about. Our tax code is complex and the rules keep changing, but what doesn't change is that you need a plan. Therefore, it's really important to plan and to prepare a cash flow analysis that will really help you understand your unique tax situation as it pertains to you. And if you've not already completed this, please reach out to us and we'll help coordinate your tax analysis with your cash flow plan as it pertains to you. It's really important, especially in the stages of retirement. You want to be prepared as best as possible. All right, now that you have the core knowledge to create your own personal plan here, or have the ability to contact us so that you can have your own personal plan, I hope you found this information informative and very enlightening. And it's always really important, as we kind of just looked at all this material, to just plan and prepare, and of course analyzing your cash flow needs as it pertains to you. And if you plan on taking additional income out of your IRA or selling a stock, double check with us before you do that so that you understand those tax ramifications. And really the important thing again is just planning and dotting I's and crossing T's so that there are no unpleasant mistakes or surprises. With that, I want to say thank you again for attending today. As always, if you have any questions, please reach out to me. We are here to help you. All right. Hope you're all safe and doing well today. Thank you. And I will look forward to seeing you soon.